Ladies and gentlemen, good day and welcome to Aditya Birla Sun Life Asset Management Q1 FY24 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, sir.
Yeah, thank you, Zico, and good evening, everyone. On behalf of InCred Equities, I welcome you all to Aditya Birla Sun Life Asset Management 1Q FY24 earnings conference call. We have along with us Mr. A. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Pugle, Head Investor Relations. We are thankful to the management for allowing us this opportunity. I would now like to hand it over to Mr. A. Balasubramanian, Managing Director and CEO of Aditya Birla Sun Life Asset Management for his opening remarks. Over to you, sir.
Thanks, Vignesh, and thank you for the introduction. And good evening to everyone attending today's investors call. And I hope you all had the opportunity to go through the earnings presentation. It's available on the stock exchanges and our website as well. Let me first begin with, as a customary, the economic outlook and the mutual fund industry update. The global economy is facing increasing expectations of rate hikes. Of course, as I speak, yesterday the 20 basis point rate hike came due to sustained growth and high inflation, and policymakers in these regions remained hawkish. Even though the headline inflation has softened, core inflation, however, remains stubborn. The global economic landscape is witnessing diverse trends, with the different regions facing unique challenges. While some central banks are adopting a hawkish stance in response to inflationary pressures, others are exploring measures to bolster their economies amid uncertainties like China. The macroeconomic outlook for India remains promising. India has thrived and continues to stand tall as one of the world's fastest growing economies, and forecasts from both global and domestic experts project a robust growth of 6 to 6.5%. This positive sentiment is underpinned by the strong fundamentals. Notably, India has boasted a healthy GDP print in FY23, a narrowing current account and fiscal deficit, well-controlled inflation, stable interest rates, impressive tax collections, and growing foreign exchange reserves. Additionally, the manufacturing sector has shown stability with a steady PMI and improved capacity utilization, leading to lower NPAs. The credit culture has also seen a positive shift, reflecting a higher repayment intent and rising tax collections. And these factors collectively point to the economic stability to sustain its growth momentum. Moreover, the government focus on infrastructure development, digital transformation, and sectoral reforms augurs well for the economy's future. The intrinsic strength of our economy can be attributed to its reliance on domestic demand, favorable demographics, political stability, and a progressive reform agenda set by the government. Additionally, the domestic manufacturing sector has received a boost through the China Plus One strategy. While the overall economic situation, as I just mentioned about it stays, with respect to the mutual fund industry, the Indian mutual fund industry's quarter average assets under management grew by about 14% year-on-year to 43 lakh crore as of June 30, 2023. They represent an increase from the previous year of 37.72 lakh crores. In Q1 FY24, the mutual fund industry witnessed inflows across equity, liquid, and ETF schemes. The industry SIP book grew by about 12,276 crores to June 2022 to about 14,734 crores in June 2023, indicating growth of about 20% year-on-year. During the quarter, the total NFO collection was about 5,500 crores, which includes the fixed income schemes. The total number of mutual fund investors stood at 14.1 crore as on June 30, 2023, an increase of 11% year-on-year compared to 13.64 crores on June 30, 2022. The industry witnessed net equity sales of around 3,900 crores in Q1 FY24 through new fund offerings and existing funds. Within the existing equity and hybrid categories, the most of the inflows have come in the arbitrage, small cap, mid cap, and large and mid cap, and the multi-asset allocation fund saw the highest inflows during the quarter. During the quarter, the industry witnessed inflows. However, there was a decline in net inflows when compared to the previous quarters in equity. During the quarter, the individual average AUM grew by about 26% year-on-year, contributed to 57% total industry average AUM. The mutual fund average AUM for June 2023 from B30 cities accounted about 17%, where there was also marginal dip compared to the previous quarter. Coming to the ABSL AMC performance, as we commence the journey of FY24, we at Aditya AMC are pleased to announce that promising start, which is of course reflected in the form of average assets under management, which has grown compared to the previous quarter. In fact, in Q1 FY24, our total assets under management, including alternate assets, have surpassed 3 lakh crores to touch 3 lakh 8,000 crores. This noteworthy accomplishment signifies considerable progress, exhibiting meaningful increase from the previous quarter's figure of 2 lakh 86,000 crores and an impressive quarter-on-quarter growth of about 8%. The mutual fund average assets under management has reached 2,97,000 crores and equity assets under management crossed 1,90,000 crores. During the quarter ending June 2023, we added about 1.2 lakh new folios as part of the broad strategy to continue to focus on customer acquisition. As a result of that, the overall folio count remained at 79 lakhs. SIP book size has increased by 10% year-on-year to about 987 crores. Our multi-channel market initiatives designed to deepen our presence have yielded positive results. We have strengthened our sales ecosystem and distribution network by bringing together the key levers like virtual relationship managers, Sampark, service to sales, direct HNI channels and digital distribution in order to provide greater support to the overall retail initiatives that as a fund house are driving it. Regarding our overall mix between retail and institutional customers, retail investors account about 49% of our assets management. As part of our overall strategy, we are focusing on building the retail portion in both B30 and B30 cities, with our contribution B30 today stands about 16%. Over the past few months and quarters, our business has been actively pursuing strategic initiatives that have yielded positive outcomes. Let me just quickly elaborate on these significant measures that we have taken to improve the overall performance of organizations, which I am sure as we progress further, will start reflecting. One, on the investment side, we continue to lead in fixed income funds with our robust performance and consistently strong market presence that we have created. On the equity side, our funds have witnessed a performance turnaround over the last few quarters and expect the same momentum to continue in the coming quarters. And most of our schemes, barring a few, have not only beaten the benchmark in the respective category on a one-year basis, also have beaten the peer group with a higher margin compared to the last few quarters, which I believe that would help in terms of building our equity as we move forward with the recent improvement that we are witnessing, which will start reflecting in the long-term performance as we move forward. We have further strengthened the investment team with the process enhancement and bolstered the team's capability. We also added sector specialists in realigned fund management responsibilities in order to give them higher responsibilities, playing to their strength while enabling the necessary resources. Also brought in sharper focus, and we have started to witness the green shoots of such change in the investment team, which is reflecting on the overall improvement of the performance. Our decision to implement a focus fund offer in order to drive our equity sales in retail as a targeted campaign has been the results garnering favorable outcomes and generating considerable traction within the market, which we measure in the form of gross sales volume improving in some of these fund offers that we have created, and hopefully should set the ball rolling for the subsequent period as well. We have developed specialized segment which caters the high net worth individual segment. Through this, we provide a comprehensive range of services and sales offerings tailored specifically to meet the needs of our valued HNI clients. Our dedicated care facility ensures that HNI investors receive specialized attention and personalized attention and exceptional service to optimize their investment experience. Furthermore, we have extended our range of valued products to include offerings such as Sampurna SIP and Turbo STP in order to build our retail as well as increase the overall customer base. Over the past financial year, we have been dedicated to expanding the size of the passive and alternate investment fund. In fact, our passive product offerings grew by about 2 times to around 28,700 crores. The expansion of our passive bouquet has been equally noteworthy, now encompassing about 40 products and attracting a growing customer base around 5 lakh folios in this. On the PMS and AA front, we have raised a commitment about 893 crores in the current quarter by launching a Category 3 India equity service-oriented fund by leveraging our multi-channel distribution footprint that we have established. During the quarter, we launched ABSL India Special Opportunities Fund and ABSL India Equity Service Portfolio under the AIF category. We also received SEBI clearance for launching an ABSL India Equity Series Fund Category 3 AIF as well. This in fact, the renewed focus we are giving on building our alternate business already started yielding results by way of collecting the first 893 crores. I am sure the subsequent pipelines will also help in building the further augment of asset class in this space. After setting up a GIFT City, we are pleased to announce the launch of ABSL Global Emerging Equity Fund, an industry first fund domiciled in GIFT City, which is in Gandhinagar, Gujarat. This fund will strategically feed into Arga Emerging Equity Fund, allowing our investors to access and benefit from emerging market opportunities. In fact, as we have taken this product to the market, we have seen reasonably good response in terms of the innovative product that we are offering to offer a solution to the investors in India under the LRS category, as well as the NRI investors who can potentially participate in the emerging market through our GIFT City product. This is the first product that we have launched in the mutual industry space, and I'm sure more such products will come in the pipeline the next few quarters. On the real estate front, we have successfully deployed to investment for the Aditya Real Estate Credit Opportunities Fund. We are also seeing the pipeline of course, proposals are many. At the same time, our effort to build our engagement with the BGO should start yielding results soon. In light of our performance, overall improvement that we are witnessing in the equity, we acknowledge the positive outcomes but also remain ever cognizant of the business dynamics, and one must steer through all the time. The markets we operate are ever-changing and dynamic in nature, and the industry landscape is also bound to encounter fluctuations and transformations in the foreseeable future. With that in mind, the only thing that we can speak with a certainty is a steadfast commitment to our vision and long-term objectives, and we shall diligently adapt to this evolving circumstances and proactively navigate potential challenges. Our unwavering dedication to excellence and strategic foresight that will be instrumental in charting the course that aligns with our stakeholders' interests. I just want to mention that as a fund house, keep making the course correction whatever is needed to build our overall finance to the next level. Moving on to the financials for the quarter, our revenue for Q1 FY24 was at 388 crores versus 273 crores in the Q1 FY23, which is up by about 42% year on year. Profit after tax for Q1 FY24 was about 184 crores in Q1 FY24 versus 102 crores last year in Q1 FY23. which again up by 79%. Of course, this number includes other income numbers. With this, I would like to conclude and open the floor for any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi, good evening everyone. So firstly on the SIP book, if I look at all the parameters that are given on slide 11, so with the number of outstanding live outstanding SIPs, new SIP registration, or the SIP book for that matter, all have been on a declining trend in a sequential basis. Even for the industry, we saw some stagnation in the month of June with respect to the overall SIP volumes. So is there a challenge in that sense to get new SIP registrations, or how do we kind of change this? Well, we always talk about penetration being very low in the country, but how do we kind of take this forward from?
Yeah, I think thanks Prayesh for this question. The SIP in general, the trend that we have seen since the time the market started getting into a complete different zone, we generally have seen the registrations versus cancellations versus expired SIPs in general have seen some rise in the cancellations and expiries, and that's primarily the reason why not only for the industry, the gross number, which is 49 crores number that we saw for the industry, is generally the net inflow as a result of these expiries. Generally, the number is low. This again for the whole industry and for us as well, we saw some kind of stagnation as a result of that. Second, which also of course came the last 3 months, I think there are certain regulatory changes which came, especially on the SIPs which need to get triggered in the form of OTP based verifications, which is more operation related issues. But also would have though I don't know the data for this, but I'm saying from behavioral point of view, also have resulted in some bit of SIPs getting dropped as a result of that. These were the two primary reasons as a result of that is something which I would say. And in terms of registration, which is a 1,400 crores number, I always feel proud about that. I think while expiries and cancellation is not in our control, but getting new customers in our control, that's what something has been rising. And for us, while it has remained stagnant at close to about 1,000 crores, though our vision has been to take it to 1,200 crores, some of the efforts that we take is in the form of launching new goal-based SAPs, convenience-based SAPs, like Sampurna SAP I mentioned about, Turbo STP I mentioned about. Some of these initiatives we are taking are more with intention to make customers to look at SAP as a long-term investing, not for short-term. And then the last piece that I want to say is, while the digital platform has been adding good amount of SAPs in terms of new customer addition, but as Analyst also mentioned that those SAPs generally get registered for low ticket, small ticket, and second is they come for sometimes 3 months, sometimes 1 year. So the drop rate at times is also in that segment is a little higher than what generally one perceives to be. I think the combination of multiple things. But clearly, from a longer term point of view, for us, especially having built a business in the last 10, 12 years, where we always take pride in building a strong retail franchise through the SAP book, I think that continues to remain as a big focus area. Though we may face some temporary challenges, but that's not something is being taken away from our radar.
Got that. And on the yield front, like there's been a drop both sequentially and YOY. Could you explain that and what kind of trajectory do we anticipate for the rest of the year?
So hi Prayesh, good afternoon. Just on the yield side, on the asset class wise, yield remain more or less same, like equity remains in the range of around 70, debt in the range of around 22 to 25 basis, and liquid remains in the range of around 12 to 13 basis. So those numbers more or less remain same. The change has happened due to the mix which is change within the asset class, and there is a growth in the liquid and liquid plus scheme which we have seen in the last quarter, resulting in a slight drop in the mix of equity, which has resulted in a drop in the yield, overall blended yield for the company. Otherwise, the overall yield remain at asset class level more or less similar.
Okay, great. And lastly, Bala sir, any thoughts on a new formidable player getting into the market in the likes of Blackstone with the kind of expertise that they have globally, especially on the passive side via their platforms, Aladdin or iShares for that matter. What is the kind of growth or challenges that you might anticipate? I know it's too early days, but any initial thoughts that would be great to hear from your side.
Yeah. Thanks, Prayesh. Of course, given the fact I'm a firm believer of Indian mutual industry crossing 100 lakh crore size the years to come. And I'm also a firm believer that way personal households will have a mutual investments in India. So going by that, I think there is a space for more people to do the hard work for expansion of the industry. I'm sure as the industry expands, as the wallet share increases, and that will of course go to established players in the mutual industry like ourselves. Just to give one analogy, when we started 25 years back, 30 years back, we were close to about 3 or 4 fund houses. Today we have 44 mutual funds, and 80% of the mutual assets and management coming from the top 10. and top 5 contributes about 53% of the AUM. So therefore, I would assume a similar trend will emerge as we move forward. Of course, more players coming in, established players coming in, will bring in new practices, no doubt. It'll bring in new product offering that could come. Will also bring in some competitive space. It will only strengthen our alertness to actually both in terms of product offering as well as an expansion of the customer base. Those will become more than a challenge. We need to also probably go a little more aggressive on that space as well. But otherwise, I would only assume it will only help in expanding the market.
Great. Thank you and all the best.
Yeah. Thanks, Rajesh.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Lalit Deo from Equirus Securities. Please go ahead with the question.
Yeah, good afternoon, sir. Thank you for the opportunity. So, sir, just like 2 questions. So, firstly, during the quarter...
Sorry to interrupt. May we request you to use your handset for optimum audio quality? Thank you.
Yeah, is this better?
Yes, sir. Go ahead.
Yeah. So, sir, just 2 questions. So, firstly, like during the quarter, we have seen some increase in our employee expenses. So, anything to read into that? And also, could you also qualitatively talk about like how has been the gross inflows in our equity schemes during the quarter as compared to the previous 2-3 quarters?
Sure. So, Lalit, on the employee expenses actually are more or less in around this number only. In last quarter, there was slight drop due to some provision, true down in the provision of variable pay and bonus. And that is why there was a drop in last quarter. Otherwise, the people remain slightly in the similar range. Obviously, there are some recruitments and backfills which we have done, which has slightly increased the number. Plus, we are strengthening our team on the alternate asset side, which is also increasing cost slightly.
Yeah. With respect to your second question on gross sales, I think we divide it into 2 parts. Though we don't disclose the numbers broadly, but I think the way I see the trend, the focused fund which I just mentioned about, which are driving it more with intention to drive those schemes which are relevant from the ownership point of view. At the same time, the sales team point of view, they remain focused in building volumes. In those focus funds, we are seeing actually increase in gross volume going up as is about 7 to 7.5% kind of range from a normal range of about 4.5 to 5%, which we have dropped. And which I see as some sense of improvement in the overall productivity, which should gain momentum with the reasonably good backup of equity performance, which I just mentioned about the earlier comment. Also is now supporting, the feel is also being felt in the ground level. I think all combination put together, we should see that improvement now getting set.
Sure. And just this last question on the alternative side, like we are growing it well. So, like, what is our vision over the next 3 to 5 years? Like, where do you see the overall AUM size on the alternate side, and how much of it should it contribute to our overall revenue and earnings?
Yeah, broadly, this one area where we are stepping away focus, Lalit, as you have seen, this 893 crores we raised after beefing up the team in the AIF side. We've seen the first success. In fact, this has helped in 2 ways. One, reaching out to all the market players, and we could communicate both on the mutual fund progress that we are making, and second, our vision for the AIF. And that has helped in terms of raising 900 crores. If they don't have confidence on AMC, even the 900 crores would not have come. So that I see as a reflection of confidence of people to give their money in the AIF side. We have created, of course, pipeline of products within the AIF equity. We have a pipeline of product on the credit side. And these two put together, given the fact this segment will also help in improving your overall profitability as a contribution, this is something has remained as a big area of focus. Right now, we are working with about 7-member team in equity We are trying to beef up our fixed income capability in terms of managing credit-oriented funds in this space. I think these two combinations put together, I think the roadmap is being set to bring in a sharper focus on our on this piece. In fact, we also given a separate in the K area for entire existing sales teams, separate K area to promote our AIF product, because the team is one, but at the same time they can actually sell multiple product as it suits for the customers. So there is a very clear vision we are setting in. For want of this thing, I'm not giving the number per se, but clearly sharper focus we are bringing on this space.
Sure, sir. That is helpful. Thank you, sir.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. A reminder to all participants, you may press star and one to ask a question. Our next question is from the line of Devesh Agarwal from IIFL Securities. Please go ahead with your question.
Good afternoon, sir, and thank you for the opportunity. So first question, I heard it right, you said on equity side our yield is around 70 basis point versus last quarter you had mentioned of around 74 basis point. So there's a good 4 basis point decline while our equity AUM remains flattish on a QOQ basis.
Devesh, the yield was in the range of around 72 to 72 basis. It is a mixture of various schemes within the equity which we are promoting, and depending on the size of the scheme which we are doing, including arbitrage or tax relief and the other scheme, that changed, but there is no big drop. It was in the range of around 72 to 70 odd basis.
Yeah, there is a big drop, Devesh. More or less the same, except on few schemes would have gone for drop for that two very minor drop would have been there. Otherwise, broadly the number remains the same.
Understood, sir. Understood. And sir, on the passive side, what is the yield that we are making?
So on passive, generally on ETF, it will be in the range of around 10 odd basis, and on the index side, it will be slightly higher. It will be in the range of around 20 odd.
Okay. So at least on a passive portfolio, it would be closer to 15-16 basis points.
So it's depending on how it moves.
But of course, we also have a product within the passive where we charge a little higher expenses, given the fact that we are bringing in some value added in terms of frequent monitoring of portfolios as well as reshuffling the portfolios depending upon index, right? Which like such as Nifty 50 equal weight index, we charge higher expenses. Then smaller mid cap index, we charge higher expenses. Though the expenses are higher as it stands today, therefore any volume increase could help in increasing the revenue. But we've been pushing it like NASDAQ fund. We do have. I think as we start seeing the volume increase on this product, we'll probably see the margins improving on that basis. Though we are currently charging higher than the normal ETF or passive fund will charge is roughly about 10 basis points. This product we are positioned like that, and with intention to improve their contribution as well in the future.
Okay. And sir, when we see the passive AUM numbers, we were seeing QOQ growth until last quarter, and it was a very healthy growth, especially in the index fund. But if we see the June quarter on a sequential basis, the numbers look very flattish. So was that any particular product like a target maturity which was doing very well until last year or last quarter, and this quarter there was some moderation in the flows into those category?
Sure. I think you rightly pointed out, Devesh. One, the ETF equity category we have seen a growth. We have seen participations rising both in terms of customer additions as well as on institutional customers coming in few of our funds, both in the Nifty and index and the banking ETF. As far as the target maturity fund concerns, it comes under the passive category. That though the AUM got closed from the passive, but they are come to the actually managed debt funds. It got shifted there because it came for maturity. So they all have to get rolled over. So Even the rollover, we can't do it in the target maturity space unless the customer wants to go for it. So those rollovers actually got shifted to the mutual funds to the extent of about 50 to 60%. And that's the reason why in the mapping, they would have gone out of the passive space.
Oh, so you're saying that is now getting into the actual debt funds or fixed income funds?
In fact, we saw a shift from the target maturity fund to the floating rate fund in the mutual fund space.
Wow. Okay. And so lastly, if I see our distribution channel mix, especially on the equity side, the share of banker channel is kind of continuously coming down. If you compare on a YOY basis, it has come down from 13% to 10%. So is there any specific reason with some bank who has stopped selling a product, or it's a general fall?
I think it was largely because of the mix actually, in terms of, I must admit that this quarter we saw significant momentum on our fixed income space in terms of growth, which we saw in the last quarter of last year. We saw a dip. Basically, we gained back and we gained more. That's primary thing. Otherwise, the banking channels more or less remain adjusting for that. In terms of product being part of the recommendations, there are certain channels where the products were part of the recommendations, but of course got dropped. But again, that keep going up and down because some of the people have changed their model of not more than recommending 2 products kind of things or 3 products kind of things. Therefore, it all comes in bits and pieces. But otherwise, the relationship engagement with the entire banking channel remains very, very strong, both as a brand, as a people, as well as the product relevance. Therefore, that is not something which I see as a gap area.
Okay, sir. Thank you so much.
Yeah.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening, sir. 2 questions. First, on the cost side, you've been mentioning for a few quarters of investment in alternates, and you're also employee additions or expanding your distribution capabilities. So just wanted to get some sense of, let's say, from a medium-term perspective, how should one think of the cost ratios from here onwards, and the core cost X of ESOPs. Second, on your overall flow trajectory, you mentioned that you're trying to push some of the schemes, select schemes in equities where you feel that the flows can be better. So if you can give some color in this preferred schemes, what would be your flow share or how that has been shaping over the past few quarters? Has there been on an increasing trend or a downward trend? And lastly, 2 data keeping questions, if you can quantify your ESOP expense for the quarter and your outstanding SIP AUM.
Yeah. On the first question on the cost front, I think only in the case of alternate fees and HNI fees, these are the 2 areas where we are looking at beefing up the team. Though HNI fees we already done, and rather direct, not HNI fees, direct as a team. We are also carving out people from our existing retail team to hold the larger responsibility on building direct. Therefore, we'll have a little increase in cost in that space, otherwise not significant. As far as the AIF concerns, of course, we have to increase our team strength in the fixed income space. We're looking at adding 1 or 2 individuals who would help us building our future on the credit-related funds, where we see a great opportunity, both in terms of building size and customer segment is also quite hot on this space. And third, of course, the margin could also be high. As far as the investment concerns, while we have done all the beefing up on the investment side, both in terms of restructuring the current responsibilities of team and given growth for the existing team, senior analyst to become a fund manager. That also because the status is changing from senior portfolio manager to the fund manager. Therefore, that could also marginally increase in cost because they have to be mapped to the market. There are 3 areas which I see as a driver for the cost increase, which is not anyway significant, but broadly these 3 items would lead to marginal increase in cost. So I can't quantify a number, but that's why I see it. And the second is gross sales. We talked about the We have chosen 4 funds, which is basically foreign equity in the large cap, and the balanced advantage fund in the hybrid category, and third the banking and financial is fund. Which is the third one?
So the multi-asset allocation.
Multi-asset allocation
balanced advantage
fund and balanced advantage fund. These are the 3 funds we have put, and even as a fund house, we started promoting multi-asset allocation fund, given the fact we are reasonably come in the top 3 in terms of AUM size, which we believe that in the current market condition, the multi-asset allocation fund could be one of the drivers, and that's something we are pushing. We are seeing these 3 funds on a month-on-month basis, improving gross sales volume. Even when I talk to my sales guys, if I ask him how is the business going, he will say my focus fund offerings, we are seeing improvement in gross sales, which is nothing but the language of people is coming, and I am saying. And the last, which I think I'll ask Prakash to answer.
So Dipanjan, the SIP AUM for this quarter is 57,500. SIP AUM is 57,543 crores, and ESOP is 6.6 crores.
Sure. Thank you, sir, and all the best.
Yeah.
Thank you. Our next question is from the line of Abhijit Sakare from Kotak Securities. Please go ahead.
Hi, good evening. So you mentioned on SIP front, you mentioned some sort of stagnation at an industry level. So is it possible to share some color maybe for ABSL or at an industry level in terms of what is the nature of the SIP closures or the slowdown that you're seeing? Whether it is really the recent additions that have happened in the last 1 or 2 years that is now sort of seeing some redemptions, or is it really the old book which is sort of booking some gains because of market gains and sort of relatively more healthy in nature?
Two trend. One, what has been coming in the last 1 or 2 years, especially the millennials, where we have been seeing some dip, not just for us, even for the industry as a whole. The old book generally they don't redeem, they stay invested for long term, given the fact they have gone through the cycles, the experience is good, and in SIP generally there is no tendency to book profit. Therefore, that I think is more or less continuous. Mostly the online platforms, whatever, as we have seen in the case of DMAT closures, right, in the DMAT market. A similar trend is also being witnessed as far as the millennials concerned. That's been the general trend that we have witnessed. In fact, the AUM that has been coming to the MFDs, generally their tendency for long term is high. The third area where we have seen general drop, even for us, we have seen marginal drop in SIPs in terms of cancellation, only on 1 or 2 schemes where maybe the performance would not have been to the satisfaction of the investors despite they being invested for long term. We saw some kind of closure on that, which I see is something which is not unique to us. General industry trend which I always seen in even the past as well. That's something we drive it through we have a system called SIP Winback. And how we can actually call back the customers, make them understand this SIP, nothing to do with the performance, is something, it's rupee cost averaging takes care. If you go with the principle of SIP way of investing, that's something we make people understand again and again. If performance is bad, therefore redeem, that doesn't mean you'll be able to catch up. Rather, we're staying invested in same scheme, you'll be able to catch up, given the fact they all put an effort to turn around the performance also on those schemes as well. So that's something we try and do it through the win-back kind of strategy that we have.
Got it, sir. Thanks a lot.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. And we have a follow-up question from Mr. Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Thank you for the opportunity again. Firstly, sir, it's more of a strategic question. Is there a customer behavior change over the past 2 or 3 years in the B30, where with the advent of the tech-driven, like we've seen even online brokers or discount brokers kind of getting into the distribution mode aggressively. So is there a different approach that even the AMCs like you guys can adopt and a direct outreach can help you scale up AUM there? Is there a different customer behavior that is expected or that has been seen in the last couple of years?
Yeah, Prayesh, I think B30, when I go back to the history, B30 special attention was given by way of giving extra incentive to the market. Since the time the extra incentive has been stopped, we have seen a reduction both in the increased customer addition as well as an increase in AUM from the B30 market. That's something which you have witnessed as a change in trend, whether it is large fund houses, small fund houses, that's there. As far as the digital platform concerns, of course, technology usage is not today restricted only to the urban cities, even rural India, not semi-urban India, or maybe most of the cities which are well penetrated. The usage of technology platforms have been rising, and some of the platforms which have come have been increasing their reach to the market. Naturally, the digital onboard or transaction coming from the deeper parts of location, B30 cities, also have been rising. One of the trends that, of course, normally witnessed in these platform is they normally give you higher weightages for recency of performance, and also give they don't look at these schemes they do by even in our own case I've seen a large flows coming in our Digital India Fund about 6 to 8 months back when the performance was extremely good, and they're all coming through the online platform. We saw inflows coming in our infrastructure fund because the performance are very good, beating the benchmark by a substantial margin. We saw that. I see online platform provides their own differentiation between thematic versus the regular schemes. That's something is a trend I see. In fact, we identified 5 of our schemes which fall in a thematic category, but diversified equity portfolio. But the performance have been extremely good. Then we also felt that maybe as a fund house, we can actually position this kind of product as part of the allocation to the investors and making it available in the online platform. But this is something which I see as a trend in online platform, and also behavior of buyers behavior, I would probably say, giving more importance for this kind of things. But otherwise, I don't see a significant buying behavior changing, or maybe the selling behavior also changing.
Got that. And so you mentioned that there is a movement from target maturity funds to floater funds. So how does that impact our yields, and do you think that this could further move to longer duration assets, say possibly 3 months, 6 months down the line, where the trajectory of interest rates is more clear?
Yeah. So basically the way it works, Prayesh, is even in the FMP days we have seen this. Whenever these schemes come for maturity, we give the rollover facility to investors as per the regulation is permitted, where the investments can continue for long term. In fact, we tell most of the investors, if you don't need this money in order to avail the longer term tax benefit, which otherwise you lose it if you redeem and then put the money back again. So I always encourage investors to stay invested in whichever scheme to which you switch, and stay for longer term as much as possible to postpone your the tax unless the need is money. This is something we normally actually as an advice we always give to investors, or rather we give this insight. Basis which if you see when the money move from target maturity fund, which gives me about say 20-20 basis points into the floating rate fund or any other funds, then naturally anything other than liquid plus the charges that you have is little higher than the target maturity fund. Therefore, ideally speaking, it should lead to an increase in margins on such kind of switches. We also encourage the switch should be ideally speaking should be 100% unless until the investors need the money during that period of maturity. This is what we normally do. I think in our case, we see roughly about 60 to 60% success in terms of that money moving to the funds which we ideally position for the switch.
Okay, got that. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Mohit from BOB Capital. Please go ahead.
Yeah. Thanks for the opportunity. So just one question, as if I look at the market share, we have reversed the trend and now we have seen an increase in the market share in the overall AUM. But if I look at equity, we have seen a little bit of decline and there's a trend that is going on. So any special steps that we take, to see that equity AUM also increases, going forward?
Sure. Now, thanks, Mohit, for asking these questions. In fact, we did go through some period of continuous decline, especially in a few of our schemes where the performance did have an impact on our growth. There is no doubt on that. In fact, the steps that we have taken in the last 6 to 9 months, as I mentioned earlier, both in terms of the shuffling of responsibilities on the team within the existing team and giving youngsters more opportunity actually to manage the funds, and change of responsibility for some of the fund managers who can take some other responsibilities, basis which brought some changes that definitely reflecting on the performance improvement that we have seen on the 1 year and 2 year and 3 year basis, both with respect to the competition, peer group as I call it, as well as to the benchmark. And that change has in fact created some kind of positivity in terms of our first level of discussion, which ideally speaking should help us in getting in more momentum on the equity space, which is what gives me confidence that the change that I brought in, the level of communication that we have to step up, and the more level of push at the ground level, which currently is being done. Unless we sound positive in the market, definitely the overall momentum cannot be built. I'm quite happy in the first quarter business momentum that I built. Ideally speaking, should help us in moving the direction.
Great. Yeah, perfect. So secondly, what are the schemes that you are intending to launch in financial year 24? Specifically on the thematic side, is there any pipeline, if you can name few of them?
Yeah, there is one fund where we already got an approval, which of course we have to look at the timing of the launch, which is the logistic fund under the thematic category. We got the approval and we'll have to, of course, plan the launch maybe in the second quarter if everything goes well. But in addition to that, we have, of course, a few products on the AIF side, as I mentioned earlier. On the AIF side, where there has been a good experience in buying our PMS products, and those products are now also being offered under the AIF side, that we see some momentum coming in. And third, which I mentioned in my opening remark, we have launched first time ever in the country as a fund in GIFT City, where all of us, an individual, can put the LRS under the LRS limit $250,000, where all of us, the individuals, can put in India. And that's something we are now going aggressive in terms of promoting it to invest in global markets using the LRS limit, which also should see some traction. The initial feelers are very good, and I don't want to, of course, put a number at this point of time. Going with the feel, it looks like it may also see some kind of good traction, both in terms of customer base as well as the AUM. Except that we have a constraint here that minimum ticket size has to be 1,20,000, 1 crore 20 lakhs is the minimum ticket size one has to put. Therefore, predominantly help in building HNI base in this space.
Okay. Lastly, anything on the branch expansion in this year? Do you intend to increase your branches?
See, I think incremental branch expansions, we are doing it jointly with Birla Capital, which we call it the One ABCD branch. So we have two-pronged strategy. One, existing branches, how we can collaborate with the no ABCD branches. Therefore, we all become one as One ABC as a strategy. That's something is been working quite well in terms of getting more customer traction, in terms of doing cross-sell sales. I'm sure more you will hear that as we start seeing the real outcome of that. And second is wherever we have identified an emerging market, about 85 locations that we have, some of the branches are matured in terms of size. We are also looking at an opportunity of converting them into a full-fledged branch. As we convert them into full-fledged branch, we'll actually add more emerging markets, which we keep identifying as ongoing process.
All right. Thank you and wish you all the best.
Yeah, thanks.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah. Thank you, everyone, and thank you for tuning in. And with this, we conclude our Q1 FY24 earnings call. And do feel free to reach out to our IR head, Prakash Bogle, for any queries that you may have. Thank you.
Thank you. On behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.